Hi and welcome to another episode of Tax and Business Matters. I'm your host, Emily Gray. Let us continue our discussion about the IRS Audit Red Flags. Number 4 on the list of IRS Audit Red Flags is home office deduction. The IRS is always very interested in this deduction, primarily because it has a pretty high adjustment rate on audit. This is because history has shown that many people who claim a home office don't meet all the requirements for properly taking the deduction, and others may overstate the benefit. If you qualify, you can deduct a percentage of your rent, real estate taxes, utilities, phone bills, insurance, and other costs that are properly allocated to the home office. That's a great deal. However, in order to take this write-off, the space must be used exclusively and on a regular basis as your principal place of business. That makes it difficult to claim a guest bedroom or children's playroom as a home office. Even if you also use the space to conduct your work, exclusive use means a specific area of the home is used only for trade or business. Not also where the family watches TV at night. Don't be afraid to take the home office deduction if you're otherwise entitled to it. Risk of audit should not keep you from taking legitimate deductions. If you have it and can prove it, then use it. Number 5. Business meals, travel and entertainment. Schedule C is a treasure trove of tax deductions for self-employeds. But it's also a goldmine for IRS agents, who know from past experience that self-employeds tend to claim excessive deductions. Most underreporting of income and overstating of deductions are done by those who are self-employed. And the IRS looks at both higher grossing sole proprietorships as well as smaller ones. Big deductions for meals, travel and entertainment are always ripe for audit. A large write-off here will set off alarm bells, especially if the amount seems too large for the business. Agents know that many filers slip in personal meals here or fail to satisfy the strict substantiation rules for these expenses. To qualify for meals or entertainment deductions, you must keep detailed records, generally documenting the following for each expense: amount, place, persons attending, business purpose and nature of discussion or meeting. Also, receipts are required for expenditures over $75 or any expense for lodging while traveling away from home. Without proper documentation, your deduction is toast. Number 6. Claiming 100% business use of vehicle. Another area that is ripe for IRS review is use of a business vehicle. When you depreciate a car, you have to list on Form 4562 which percentage of its use during the year is for business. Claiming 100% business use for an automobile on Schedule C is red meat for IRS agents. They know that it's extremely rare that an individual actually uses a vehicle 100% of the time for business, especially if no other vehicle is available for personal use. IRS agents are trained to focus on this issue and will closely scrutinize your records. Make sure you keep very detailed mileage logs and precise calendar entries for the purpose of every road trip. Sloppy record keeping makes it easy for the revenue agent to disallow your deduction. As a reminder, even if you use the IRS standard mileage rate to deduct your business vehicle costs, ensure that you are not also claiming actual expenses for maintenance, insurance and other out-of-pocket costs. The IRS has found filer non-compliance in this area as well and will look for this. Number 7. Cash businesses. Small business owners, especially those in cash-intensive businesses, taxi drivers, car washes, bars, hair salons, restaurants and the like, are an easy target for IRS auditors. The agency is well aware that those who primarily receive cash in their business are less likely to accurately report all of their taxable income. The IRS wants to narrow the tax gap, and history has shown that cash-based businesses are a good source of audit adjustments. It has a new guide for agents to use when auditing cash-intensive businesses, telling how to interview owners and noting various indicators of unreported income. That's all for now on the IRS Audit Red Flags. We will discuss the rest of the list on the next shows. So please do join me again next time. I'm your host, Emily Gray. Check on the programs you missed at www.howtodouryourowntaxes.com. Until next time, goodbye for now.